What a bloody Monday, and you know who to blame. It's the Federal Reserve. They've absolutely messed up this cycle like nothing I've ever seen before. Let's look at technical levels. On the S&P, we're breaking through 4,000, it looks like. I mean, we've had a little bit of a bounce past 20 minutes, but where you want to be looking for a full bear market is 3,800. So if we get there, then everyone's going to be talking recession, and it's going to get a lot worse. But as far as U.S. stocks should fare better than Eurostoxx that are already in a bear market. This is 20% off the highs there. And going back to when the ECB started getting hawkish, yep, that's what happens. I mean, you take bonds and you crush them, and that's what happens. This is one of the most ridiculous bond charts I've ever seen on the 2-year. Completely telegraphed by the Fed, so let's feed some bond vigilantes, and you hope that we start to get constructive, because the more money that's being pulled out of the market, the less investable assets we have, and the worse of a future we have, because companies aren't using that money to give us product that we can then consume. It's just a little bit of a problem there. The 10-year is really what people are using to price equities, and you can see similar action there, not quite as sharp. 30-year bond is starting to get a little bit of a bid. And you can see why. There's a technical level right here where people are thinking, okay, well, maybe it's time for wealth preservation reasons to start adding the 30-year to the portfolio. But man, it's not looking pretty. And I don't know what the Fed's looking at, because the metals that are usually key indicators of, well, are we going to have inflation like copper, or a recession like copper? They're falling apart. So the Fed's getting really hawk into a weak metals market. The grains are still super high, but it has to do with the war. And don't expect these corn prices to hold up. If the corn prices start falling apart, or even if these start staying high, then we have stagflation, and we have an even bigger problem for the U.S. equity market. I mean, not so much the U.S. equity market, because the United States has no problem feeding itself, but it's the rest of the world that has a problem. If you want to talk about Eurostoxx again, I mean, these are mostly levered towards these yields. They've been doing more QE, and I think they have further to fall. So I'd be stock replacing, and what that means is selling your stock, buying a little bit of calls so that you have some upside, because there's going to be some pretty vicious bounces when it comes to what we're talking about in the market. And I think from here we probably bounce up into the 4100s. That's a 100-point ripper, and then we fall back down, because we are probably going to hit this bear market level. So let me know in the chat what people think and what stocks they're picking. This is a terrible macro environment for stock pickers, and that's what is pretty frustrating.